You paid your premium every single month. You never missed one. And then the accident happened, and your insurance company told you they weren't going to cover it. That moment hits different when you're standing in a parking lot, staring at a crumpled bumper, phone in hand, trying to figure out what you actually paid for all these years. Here's the thing most drivers never find out until it's too late. Your auto insurance policy has gaps. Real ones. Gaps that are written right into the contract you signed, in plain English, that almost nobody reads until there's a claim on the table. This video is not here to scare you. It's here to show you exactly where those gaps live, what triggers them, and how to figure out whether your current policy leaves you exposed before you ever need to file a claim. Let's start with something that surprises almost everyone who hears it for the first time. In 49 out of 50 states, you are legally required to carry auto insurance. That's not a suggestion, that's the law. But here's what the law does not require: that your insurance actually covers you. When your state says you need liability coverage, what they mean is coverage that pays for the other driver's car and the other driver's medical bills if you cause a crash. Your car, your injuries, those are a separate question entirely. A lot of drivers hear, "I have insurance," and assume that means they're protected in every direction. That's not how the product works. Minimum liability is a floor for other people's protection, not yours. Think about what that means on a real road. You rear-end someone at a light. Your liability coverage kicks in and pays to repair their bumper and covers their ER visit. Your own car sits in the shop for 2 weeks, and your own out-of-pocket costs start climbing, and your minimum policy is already done doing its job. That's not a loophole. That's how the product was designed. The average American driver carries what their state requires, plus maybe a little more. Most of them have never read past the declarations page, the summary sheet that shows the coverage names and dollar amounts without explaining when those amounts actually apply. The declarations page tells you what you have. It doesn't tell you what it won't do. And the gaps are not hidden in the back of the document under dense legal language. A lot of them are right there in the coverage structure itself, visible once you know what you're looking for. So let's walk through them one by one, starting with the one that catches people the most off guard. Uninsured motorist coverage sounds self-explanatory. If someone without insurance hits you, this coverage handles it. Simple enough. Except there's a version of this problem that most drivers never anticipate. The driver who technically has insurance, but whose policy limits run out before your damages are covered. That's called underinsured motorist coverage, and it's different. In many states, you have to purchase it separately. In some states, your insurer is required to offer it to you, but if you declined it when you signed up, it's not there when you need it. According to the Insurance Research Council, roughly 1 in 8 drivers on American roads right now is uninsured. In some states, that number climbs closer to 1 in 4. That means every single time you're on a highway, statistically, multiple cars around you have no coverage at all. If one of them hits you, and you don't have uninsured motorist coverage, the path to recovering your costs runs through their personal finances, which, if they couldn't afford insurance, gives you a pretty clear picture of what that process looks like. This is the gap that feels impossible until the moment you need it, and then it feels obvious. Now let's talk about the gap that lives inside collision and comprehensive coverage, because even drivers who pay for both are often surprised by what the payout actually looks like. When your car gets totaled, your insurer doesn't write you a check for what you paid for the vehicle. They write you a check for what the vehicle is worth on the day of the accident. Those two numbers are almost never the same. A brand new car loses somewhere between 9 and 11% of its value the moment you drive it off the lot. By the end of the first year, that number climbs to around 20%. Your premium, meanwhile, is calculated based on replacement cost estimates that can lag behind actual market conditions. So if you financed your car and you're 2 years into a 5-year loan, there's a very real chance you owe more on the vehicle than it's currently worth. If that car gets totaled, your insurer pays market value, and you're still on the hook for the remaining loan balance out of pocket. That difference is called the gap, and the coverage that addresses it is, logically, called gap insurance. It's not automatically included in standard policies. You have to add it, and most people only find out it exists after they've already needed it. Collision coverage handles crashes. Comprehensive handles almost everything else: theft, hail, a tree branch through your windshield, a deer that walks into your lane at night. But both of these come with a deductible you chose when you signed up, and that deductible shapes your actual payout in ways people sometimes forget. If you set a $1,000 deductible to lower your monthly premium, you're agreeing to absorb the first $1,000 of any covered repair yourself. A $2,000 hail damage claim becomes a $1,000 check. A $900 repair becomes your problem entirely because it never clears the deductible threshold. There's nothing wrong with a high deductible if you've thought it through. The problem is when people choose a deductible based on the monthly savings without connecting it to what a realistic repair actually costs in their area. Here's another coverage layer that most drivers with a standard policy simply don't have: rental reimbursement. When your car is in the shop after a covered claim, you still need to get to work, pick up your kids, handle your life. Rental reimbursement covers a daily amount for a substitute vehicle during that window. Without it, you're paying for that rental car yourself. And if the repair takes 2 weeks, those daily costs add up fast, especially at today's rental rates, which have climbed significantly since 2021 and haven't fully come back down. Some policies include rental reimbursement as a default add-on, many don't, and the daily limit matters just as much as whether you have it at all. A policy that reimburses $25 a day sounds reasonable until you realize the cheapest available rental in your city runs $45. Let's shift to something that affects drivers who work from home less often than it used to, but still catches people off guard when the situation arises. If you use your personal vehicle for work purposes, driving to client sites, delivering goods, transporting passengers, your personal auto policy may not cover you while you're doing it. Personal auto insurance is priced and structured around personal use. The moment your car becomes a business tool, the risk profile changes, and insurers treat that differently. Rideshare drivers learned this the hard way in the early years of that industry. Drivers assumed their personal policy covered them between rides. It often didn't. The gap between logging into the app and accepting a ride request was a coverage blind spot that left people exposed in a very specific window that no policy was originally designed to address. Most major rideshare platforms have since added their own coverage layers for drivers, but the lesson applies to anyone who uses a personal vehicle in a commercial context more broadly. If your work involves vehicle use that goes beyond a standard commute, that's worth a direct conversation with whoever holds your policy. The same principle applies to vehicles you borrow regularly but don't own. If you drive your partner's car, your parents' car, or a friend's vehicle on a consistent basis, you may not be covered under their policy for that pattern of use. Occasional borrowing with permission is usually fine. Regular use of a vehicle you don't own can create a coverage question that doesn't resolve cleanly in your favor when a claim comes in. What matters here is not memorizing every exclusion by name. What matters is understanding the structural logic. Personal auto insurance was built for personal, non-commercial, owner-operated use. The further your situation moves from that baseline, the more deliberately you need to verify what actually applies to you. There's another category of exclusion that hits closer to home than most people expect, and it has nothing to do with who was driving or who was at fault. It has to do with what was inside the car. Your auto insurance policy covers the vehicle. It does not cover the stuff inside it. If your laptop, your camera gear, your gym bag, or your child's car seat gets stolen or destroyed in an accident, your auto policy is not going to replace any of it. Personal property inside a vehicle typically falls under renter's insurance or homeowner's insurance, if you have either of those, and if the claim meets the deductible threshold. If you're renting and skipped renter's insurance because it seemed like an unnecessary expense, a car break-in is often the moment that assumption gets expensive. The car seat situation specifically catches a lot of parents off guard. Many pediatric safety organizations recommend replacing a car seat after any crash, even a moderate one, because internal stress fractures may not be visible but can compromise the seat's effectiveness. Whether your insurance covers that replacement and under which policy depends entirely on your specific coverage terms and the severity classification of the accident. Now let's talk about something that trips up people who move between states or who recently relocated. Auto insurance minimum requirements are set at the state level, and they vary significantly. What satisfies the legal requirement in one state may be technically insufficient in another. If you moved from a state with lower minimum requirements and simply transferred your existing policy without reviewing coverage levels, you might be carrying a policy that meets your old state's floor but sits below your new state's standards, or vice versa, meaning you may be paying for coverage levels that exceed what's locally required, which isn't necessarily a problem, but is worth understanding. The more practical concern is this: if you live near a state border and regularly drive across it, your coverage generally follows you, but the minimum requirements in the neighboring state don't override your policy terms. If an accident happens across the state line, the claim still runs through your home state policy, not the other state's rules. Weather-related damage is another area where the coverage picture is less clear than most drivers assume. Flood damage is specifically excluded from most standard auto policies. Comprehensive coverage handles rain, hail, and storms in most cases, but flooding, especially when the vehicle is parked in a flood-prone area or driven through high water, can trigger exclusion language that leaves the claim unresolved. This matters more than it used to. Flooding events across the United States have become more frequent and more geographically unpredictable in recent years. Drivers who live in areas not historically associated with flood risk are encountering it anyway, and discovering after the fact that their policy's treatment of flood damage is different from how they imagined it. If your area has seen flooding in the last 5 years, even once, it's worth pulling out your policy and reading specifically how your comprehensive coverage defines and limits flood-related claims. Mechanical breakdown is another blind spot. If your engine seizes, your transmission fails, or your brakes give out due to wear and age, your auto insurance policy will not cover the repair. Auto insurance is designed to respond to sudden, external events, collisions, theft, weather. It is not a maintenance plan or a mechanical warranty. The practical implication is that drivers who are counting on their auto policy as a financial backstop for any car-related expense are working with an incomplete picture. The policy addresses accidents. Everything else is either a warranty, a service contract, or out-of-pocket. Custom parts and aftermarket modifications are treated differently than factory equipment as well. If you've added upgraded wheels, a custom sound system, a lift kit, or any non-factory component to your vehicle, standard collision and comprehensive coverage may only reimburse you for the factory equivalent, not the upgraded version you actually installed. Some policies have an add-on specifically for custom equipment coverage. If you put money into your vehicle beyond the original factory build, it's worth checking whether that investment is reflected anywhere in your current coverage terms. The pattern across all of these gaps follows the same logic. The policy was built around a specific, narrow set of assumptions about how a vehicle is used, what it contains, and what counts as a covered event. The further your situation moves from those assumptions, the more likely you are to find a gap waiting underneath. So where does all of this leave you right now? Probably somewhere between mildly unsettled and genuinely curious about what your own policy actually says. That's the right place to be, because the goal from here isn't anxiety, it's a checklist. A real one. The first thing worth pulling out is your declarations page. That's the summary document, usually 1 or 2 pages, that lives in your email inbox from when you first signed up or renewed. It lists your coverage types, your limits, and your deductibles. Read it like you're looking for gaps, not reassurance. Start with liability. Note the 2 numbers, bodily injury per person and bodily injury per accident. Those are your exposure limits if you cause a crash and someone is seriously injured. If either of those numbers is close to your state's legal minimum, it's worth understanding what that actually means in terms of real-world medical costs. A serious injury in a car accident can produce medical bills that far exceed state minimum liability limits in a matter of hours. If your coverage cap is reached and the other party's damages aren't fully covered, the remaining balance can become a personal liability issue, meaning your own finances could be on the table in a lawsuit. Next, check whether uninsured and underinsured motorist coverage appears on your declarations page at all. If it's not listed, you don't have it. If it is listed, note the limit, and consider whether it's proportional to your liability coverage. Mismatched limits between what you carry for others and what you carry for yourself is a common structural gap that doesn't get caught until it matters. Look at whether you have medical payments coverage or personal injury protection. These are separate from liability. They cover your own medical costs after an accident, regardless of who caused it. In no-fault states, personal injury protection is often required, but the coverage amount still varies, and the limits may be lower than a real emergency would demand. Check your collision and comprehensive deductibles. Write down both numbers. Then ask yourself honestly, if you had to pay that amount tomorrow, is it money you have available? If the deductible is set higher than what you could realistically absorb without financial strain, that's worth noting as a pressure point. Look for gap coverage if you're currently financing or leasing your vehicle. If you're still making payments, and you don't see gap coverage listed, you now know the specific risk that creates. Not as a crisis, just as a variable you can address the next time your policy renews or the next time you speak with your insurer. Check for rental reimbursement. It's a small line item, easy to add, and easy to miss. If it's not there and your car is your primary way of getting to work, the absence of that coverage could mean a significant out-of-pocket cost during a repair window. If you've added anything to your vehicle beyond factory equipment, upgraded audio, custom wheels, a roof rack, aftermarket lighting, check whether any of those are reflected in your policy. If they're not documented anywhere, they may not be included in a claim payout. Now look at your usage patterns against what your policy assumes. Do you use your car for anything that goes beyond commuting and personal errands? Do you lend it to anyone on a regular basis? Has your annual mileage changed significantly since you last updated your policy? Each of these can shift the accuracy of your coverage without triggering any automatic update from your insurer. The reason none of this gets caught sooner is that policies don't come with a highlighted gap report. They come as documents you're supposed to read at signing, under time pressure, often while you're also managing the logistics of buying a car. Most people sign, file the paperwork, and assume the policy is doing its job until something forces a closer look. The good news is that reviewing your own coverage takes less time than most people expect. 30 minutes with your declarations page and a few direct questions to your insurer's customer service line is usually enough to get clarity on the items that matter most to your specific situation. You don't need to know every exclusion by name. You need to know whether the coverage you're paying for lines up with the life you're actually living, the car you drive, the way you use it, what's inside it, and what your financial exposure looks like if something goes wrong. Most drivers never ask those questions until they're standing at the scene of an accident, or sitting in a repair shop waiting room, or opening a letter from a claims adjuster. You now have the information to ask them before any of that happens. That's not a small thing. The system wasn't built to hand you this picture up front. You had to come looking for it. And the fact that you did puts you in a genuinely different position than most people on the road. Pull out that declarations page tonight. Read the numbers. Compare them to what you now know. And then decide, clearly, calmly, on your own terms, whether your coverage actually fits your life.